Right now, the most critical maritime choke point on Earth operates at a fraction of its capacity, and the White House threatens to strike a match. 3 weeks ago, President Trump signed a fragile Memorandum of Understanding with Iran. The markets cheered, oil tumbled, and gas prices began a slow crawl back down to earth. But yesterday, that brief window of peace was declared dead. The administration pivoted, threatening to resume a full naval blockade on the strait. On paper, this reads as a display of absolute geopolitical dominance. In reality, it is a high-stakes play being made while the underlying economic math signals a significant domestic vulnerability. We just had 3 weeks of a partially reopened strait. In that brief window, roughly 200 million barrels of oil managed to get out to the broader market. This scale shows exactly how small that volume actually is. Those 200 million barrels equate to just 2 days of global energy demand. Worse, the bottleneck remains severely paralyzed. Commercial tanker traffic is limping along at only a third of its normal capacity because captains simply aren't willing to risk the passage. Because of that ongoing global paralysis, America has had to compensate internally. Our own domestic energy safety net is bearing the weight of this shortfall. This massive disparity between what got through the strait and what the world actually needs puts an immense amount of pressure on our internal storage facilities to fill the gap. To understand that pressure, look at the Strategic Petroleum Reserve. It's designed to be the nation's ultimate defense against cataclysmic supply shocks. Today, that reserve has been drawn down to just 319.5 million barrels. That is a 23% drop from its pre-war levels. To put that drop in perspective, the emergency stockpile is sitting at its lowest point since the Reagan administration began filling it back in 1983. The federal government has exhausted its emergency padding. If the global supply chain snaps tomorrow, there is zero macro-level defense remaining to cushion the blow. If the Federal Reserves look depleted, the commercial stockpiles are hitting a physical breaking point. Take Cushing, Oklahoma. Cushing is the pipeline crossroads of America. It is the exact junction where the physical delivery of crude oil meets the financial trading markets. Right now, even after a minor rebound last week, inventories at Cushing have plummeted below the critical 20 million barrel operational stress level. Once the physical volume drops below 20 million barrels, the pipeline system physically loses the internal pressure required to operate. Without that baseline pressure, the facility struggles to pump crude into destination refineries. The physical flow stops. We have a depleted Federal Reserve alongside a failing commercial hub. U.S. infrastructure is paralyzed and incapable of supporting an aggressive trade war. Replacing that lost oil is currently cost prohibitive. Commissioning a tanker outside the strait costs around $4 to $5 million. But if you want a vessel from inside the choke point, the risk premium doubles that cost to $8 to $10 million. And there is a ticking clock on the supply we do have access to. Out of the 200 million barrels that escaped recently, roughly 60 million were Iranian crude. On Tuesday, the administration slapped sanctions back on that specific oil. Buyers have exactly 10 days to take delivery before that supply becomes completely off-limits. By reinstating these sanctions, the administration is actively choking off replacement supply before we've had any chance to refill our own critically empty infrastructure. While projecting leverage in public, President Trump admitted at June's G7 meeting that he is privately terrified of an economic catastrophe, one that would earn him comparisons to Depression-era President Herbert Hoover. The stock market might seem relatively quiet, but the bond market is starting to react. While stocks stay quiet, this is exactly where the actual underlying cost of geopolitical risk is being priced in. Look at this line chart tracking the 10-year U.S. Treasury yield. The metric shows a violent vertical spike, hitting a wartime peak of 4.57%. When you overlay this spike with consumer inflation data, the signal is clear. Investors are signaling that inflation isn't finished and a severe energy crisis is imminent. This metric ties directly back to the geopolitical bluff. A blockaded strait means an unavoidable direct hit to the domestic economy. Geopolitical dominance is a mathematical impossibility when you are operating with an empty Federal Reserve and dry commercial pipelines. You cannot win an economic war when your own tanks are empty.